بسم الله الرحمن الرحيم. اللقاء الفات حكينا عن الريسك اند ريتيرن، البورتفوليو ريسك اند ريتيرن، هذا مثال بسيط لكيف نحسب الريسك اند ريتيرن. ملخص المثال طبعا هاي بتقرأوه، بس ملخص المثال كالتالي. This is the summary of the question. The summary of the question: if we invest 50% of the S&P 500, this is the index, and 50% in the international fund. يعني احنا وزعنا الاستثمار بين two different investments in S&P 500 fund and international funds is like this. يعني احنا معنا $1000, we have $1000, and we divided $1000 50% investment in the S&P 500 and 50% in the international. Okay? So the weighted average here is 50%, and the weighted here is 50%. The expected return of the S&P 500 is 12%. So our S&P is equal to 12%. So again, we have like this portfolio. This is investment in S&P 500. Okay, and this is in the international. And giving this information, the weight of this 50%, and weight of this is 50%. R is 12% for, and R here is 14%. The standard deviation sigma is 20%. And sigma here is 30%. Now we want to calculate the return of this portfolio, R of portfolio, and the sigma of the portfolio, and the risk of the portfolio. So the R of this portfolio is, we apply the equation WI or W1 R1 plus W2 R2, because we have two investments or two securities. So the weight is for the international is 50% times 14% plus W2 here 50% times 12%. So here 7% plus 6, so we have 13%. So the answer of the retained portfolio is equal 30%. Okay, any question? Okay, then we will calculate the sigma B, the sigma of the portfolio. So sigma B of the portfolio is equal
weighted 1 square.
The root of weight 1 squared, sigma 1 squared plus weight 2 squared, sigma 2 squared plus 2 W1 sigma 1, sorry, W1 W2 sig rho 1 2 sigma 1 sigma 2. Okay, so now the sigma B, the sigma of the portfolio, is like this. To apply this equation, it's equal W1 squared 50 squared times sigma 1 squared 30% squared plus W2 squared 50 squared times sigma 2 squared 20 squared plus 2W1 50 times 50 times the rho. What is the rho in this example? 0.75. Go back to the example here, and you will see the rho is 75. This one.
0.75.
The rho is 75. Then 0.75 times sigma 1, 30 times 20. Okay? So then the answer is 23.5%. Now, if we change the weighted average for each investment, for instance, we invest 50% and 50%. 50% in S&P 500
And 50 in international.
and 50 in international. Let's go back to the example here, just to see which hold higher risk, international or S&P 500. International. Why? Because the standard deviation. So what we will do now, just to replace the weight. Let's see, to invest 80% in I, in international, and 20% in S&P 500. What is the reflection of the change of weight on the stock return and on the portfolio risk? What is the reflection of increasing the risky assets, because this is holding higher risk, on the return?
Would be high.
Well, yes, it will increase the return. Okay, and greater than the previous portfolio. Okay. Let's go to another example, or to see, yes, systematic risk and the market portfolio. This is another example. Try to just change the weight and see what is the implication of weight on the risk and return of the portfolio. Now, systematic risk and market portfolio. What it means, systematic risk? What it means, systematic risk? Okay? Yes?
It means that the risk will influence on the return.
Say it again?
The risk will influence the return.
The risk
Investment.
influence the return of investment. This is general. The risk, if there is increase in risk, it will increase in the return. But what this systematic risk? What you say is the total risk. The total risk is equal systematic risk
Plus unsystematic.
systematic plus unsystematic. Now, what is the difference between systematic and unsystematic? Sorry?
Systematic risk, the risk that contribute in the market, but unsystematic eliminate the risk will not contribute in the market.
Yeah, you are right. Yes. Systematic risk is to what extent a particular stock influenced by the changes in the market return. Again, the systematic risk, in other words, the systematic risk is the sensitivity of the stock return with regard to the market return. Unsystematic risk is related to the individual risk of a particular company.
had unsystematic.
Unsystematic. Okay, again, the systematic risk, to what extent the stock return influenced by the changes in the market return. This is systematic risk. Unsystematic risk is the risk related to the individual company. Systematic risk, we cannot eliminate it away. The systematic risk, we cannot eliminate it away. It is non-diversifiable risk. However, unsystematic risk, we can avoid it, we can eliminate it. We will see what it means from the from practical point of view, the systematic risk and the unsystematic risk. The systematic risk, according to our definition, is the sensitivity of the stock return with regard to the changes in the market return. Let's see, we have RI. RI, consider Google, the R of Google. We have observation for R of Google, the return observation, the daily return observations for Google. And we have daily return for the market. Let's say the market is S&P 500. Why we select S&P 500? Because S&P 500 is the market where is the Google work, or where is the Google listed. So this is considered as a market return, and this is considered as the stock return. Okay? So as long as this return move, what is the implication of this change on this stock? So if the markets go up, what is the implication of the Google? The Google could be go up or go down. So this is the idea in here. And this is lead us to calculate beta. In the previous section, we talked about the correlation. The correlation coefficient between two different stocks, stock I and stock J, or A and B. Investors, generally, they don't have, or it's very hard to calculate the correlation for each stock with every stock in the markets. Suppose we have 3,000 stocks. So you want to compare this stock with the 3,000s and the second stock with the 3,000s. So it is a very complicated. Because of these weaknesses of the correlation, and it is hard to apply in the markets, they provide the measure of beta. Take this example here, and this example in this student. For instance, we can compare Amina with Fatima. Okay, Amina and Fatima, we can make a correlation between them. The marks of Amina and the marks of Fatima. But this is misleading. This is misleading because we are comparing two individual students. Maybe, let's see, Amina A, Fatima F, has the grades of 85%, and this has, let's see, 90%. What we can do in this, we say, okay, F is greater than A. So we will prefer in F, prefer to invest with F. This is unfair, because we just limited ourselves in two students. Let's see, consider this case. If we take the average of the students, the average of the students is 70%. Then we can compare A with the average and F with the average and see, okay, altogether A and F are great students. Okay? Take another example with another two students. If we have C and Y, C 70%, or let's say 69%, and this is 65%. We will see that C is much better than Y. But in reality, both of them are not doing well. So in this case, we have a misleading results. So we want to compare with the rest of the students. So the average of the student, all of the students together, considered as the average class. It's considered in finance, we consider RM is the average return for the stocks listed in the financial markets. So we compare each stock with the financial markets. But in the previous section, we compare each stock with another stock, which is misleading. So this is why the beta is more important because it measures the systematic risk for each stock with regard to the change with the markets, not with regard to the change to the individual stocks. Okay? So this is the importance of beta. And the market portfolio is the market or the return of all of the stocks listed in the financial markets. But in reality, we cannot calculate all of the stocks or the average of the return of all of the stocks listed in the financial markets. Why? Because we have strong stocks, we have weak stocks, we have stocks with different styles. See, for example, this. If you talk about New York Stock Exchange, we have thousands of stocks. So New York Stock Exchange decided to form something known index. Muashir, the index. So in the New York Stock Exchange, they select the first 500 companies. The first 500 companies represent the financial markets. So we don't need to calculate all of the stock listed in the financial markets. We just only take the first 500 companies based on a particular criteria. This is why they formed the S&P 500, Standard & Poor 500. S&P 500 is an index, includes the first 500 companies in the United States, in the New York Stock Exchange. This, in the same vein, if we talk about London Stock Exchange, London Stock Exchange also includes thousands of companies. So they form the index with the first 100 companies. And they call their index FTSE 100. Okay? Financial Times Stock Exchange 100. So FTSE 100 includes the first 100 companies in the London Stock Exchange. So we consider this is the market return. Just to calculate the return of the 100 stocks, so this is considered as the market return. So we compare, if we have company A, we compare company A with the FTSE. Company B with FTSE. We are not comparing company A with company B. If we compare between A and B, we calculate the correlation or rho. But if we calculate A with the FTSE 100, we estimate beta. Okay? So is beta going well with you, yeah? Is right. It is the first time to introduce beta here, no?
Yes.
First time? Second time?
No, first.
First time. So you know what it means, beta. Okay. So, and you know what it means market portfolio. It will be hard to calculate the correlations when we have thousands of possible investments, as I explained. If we want to invest, if we have thousands of stocks and you compare one with the rest, two with the rest, three with the rest, it's very complicated. So just you can calculate beta for each and end. Capital asset pricing model,
CAPM.
or the CAPM, provides a relatively simple measure of risk. The CAPM, which measure R, let's say Google, the R of Google, the return of Google is a function of RF, risk-free, plus beta, I explain what it means, beta, times RM minus RF. So I explain what it means, beta. I explain what it means, RM, the market return, which is the return of the index, and the RF, just, this is the security market line. This is the risk-free RF. What it means, risk-free, it means the assets holding no risk. This is risk-free. In the United States, is the treasury bills. Okay?
هي سيستماتيك كمان. النص تكون هي سيستماتيك تحت.
It reflects the systematic risk. This area in here is systematic risk. This area is systematic risk. And this area is here unsystematic risk. We will go back to this. We will go back to the more explanation about the CAPM. This is CAPM, capital asset pricing model. So it means if we have higher beta, we have higher return for Google. If we have two stocks with the similar or same beta, we have same return. CAPM assumes that investors choose to hold the optimally diversified portfolio that includes all risky investments. This optimally diversified portfolio that includes all of the economic assets is referred to the market portfolio. The market portfolio are invested in all of the stocks. And all of these stocks are risky assets. If we look at here, only invested in this area, no risk. But if you invest in these areas, all of these securities are risky assets. Why? Because in here there is no, the risk is zero. When you move to the right, your risk is increased. Okay? According to the CAPM, the relevant risk of an investment relates to how the investment contributes to the risk of this market portfolio. Okay? So it means how each investment contributes to the risk of this market portfolio. If we have stocks with different betas, beta could be 1, beta could be 0.5, beta could be 2, beta could be 3. Now, the risk of the portfolio depends on the betas of each stock. So it means the beta of portfolio is the contributions of each one. Okay? We will see in an example how things work. Okay? For instance, if I want to form higher beta, higher portfolio, or higher risky portfolio, so what I will do is just depend with the stocks with the higher beta. If I want to have less risky portfolio, I will include the asset with the lower risky portfolio. Now, let's see. You have this option. You have 1, 2, 3, 4, 5, 6. So A, B, C, D, F, J. This is, the beta is 0, 1, 5, 2, 1.8, let's see, 3. If I ask you, you have option to form 2 portfolios. In each portfolio, you have option to select the 3 stocks. Again, you have option to form 2 portfolios. In each portfolio, you have to select the 3 stocks. The first one holding higher risk. The second one holding lower risk. Okay, so which one? Let's talk about the higher risk. Which beta you will include in the first with the higher risk? You have from 0 to you have 0, 1, 5, 2. You have option to select the 3 stocks in the portfolio. So portfolio A, the first portfolio A, which stocks you will include?
C.
Name them. C. So we select C, D, and J. So the beta of this will be high. So the beta is calculated based on the contribution of each investment in the portfolio, in the total portfolio. Now for B, with the lower risk, so
A 0.
A, yes.
B.
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 B F. B F.
B. What is B? Okay, B
F.
and F. Yes. So we have C, D, J. We have A, B, F. So this is with lower risk, because the contribution of beta
Will be lower.
is low. Okay. As we explained before, each stock or each portfolio has 2 different risks: the systematic risk and the unsystematic risk. All together form the total risk. For the systematic risk, we cannot eliminate it away for the systematic risk. And take this example, just to form or to see مش عارف مش ماسك. طيب here is the number of stocks or the number of securities. The number of securities. And here is the total risk. If we invest in only one stock, we will have this risk. Okay? If we add another stock, the risk is in here. If we add 3, the risk will be here. If we add 6, the risk will be here. If we add 9 stocks, the risk will be here. If we add 12, the risk will be here. $24 will be here, 50 will be here, and so on. What we observe in this if we put all of our investments, if we have $1,000 and we invest all of the $1,000 in one risky asset, we will have this return. Let's say this return is 15%, or this risk. If we invest in 9 stocks, the risk decrease. 12 decrease, 50 decrease, and there is no change. If we add new stocks, there's very, very little change. Because what is the idea in here? The idea is like this. We cannot eliminate this area. Here is the unsystematic risk. Here is the systematic risk. So, in this systematic risk, we cannot eliminate the impact of systematic risk on the market portfolio. But we can eliminate the impact of the unsystematic risk on the market portfolio by increasing the number of the stocks included in the portfolio. Why? Because the systematic risk hits all of the stock or securities. And this is why it's considered the systematic risk. It's called as the market-wide risk. Market-wide risk. Systematic risk reflects the risk of all of the market portfolio. But the unsystematic risk, it holds the risk of the individual stocks. Okay? Any question for the systematic and non-systematic? Okay, now let's see this example here. This is unsystematic, and this is systematic. And this company, this is unsystematic, and this is systematic. Invest in 3 stocks. Make the total risk to be low, to be lower than the invested in 2 stocks. And what exactly we are doing here, we are just reducing the contribution of the stocks with the total risk, the contribution of the portfolio in the total risk. Okay, so this is the importance of the systematic risk and the unsystematic risk. The systematic risk components, what the systematic risk includes, component measures the contribution of the investment to the risk of the markets. For example, war, hike in corporate tax rates, increase in the corporate tax. So the systematic risk, we cannot avoid or eliminate it away because it is the contribution of war, contribution of the increase in corporate tax, and to what extent the individual beta or individual systematic risk influenced by the systematic risk. In other way, if we have a war, yes, it's right that the war hit all of the securities. Okay, according to this information. But the war influence on the individual securities in different ways. Okay? So, some companies, if we have these companies, company A, B, C, and so on, let's say take company A. company A working as producing cars. Okay, car industries. In the world, the demand on car will decrease. So because of the war, the war is systematic risk, or the contribution, or let's say the components of the systematic risk. So the car industries will decrease. I mean, the stocks of the car industries will decrease. So their beta will decrease. Why? Because the markets decrease. The market decrease, and the beta of this, let's say Volkswagen, for instance, decrease. Now look at another example here. If we talk about the war, then the medicine companies will increase. So it's work against the markets. So the medicine market will increase. So the beta will be negative. The beta will increase, so the market decrease, and the beta of this increase. Now, what it means what is the contribution of this company with the risk of the markets? Again, some companies move with the market, other companies move against the markets. So the idea here, when we are forming the portfolio, we will see the contribution of each company in the total risk, okay, or in the systematic risk. Take an example here in Gaza, or in the Middle East. In the Middle East, if we have problems, or let's say war in the Middle East, the hotel industries, the hotel services or the stocks will decrease, because the economy or the market decrease, then the hotels decrease. But if we talk about the weapon industries, will increase, like the companies producing the weapons increase. Why? Because it moves against. So the beta of this is minus, and the beta of this is positive, because it's moved to the. This go to the market. So this contribute positively with the market. This contribute negatively with the market. So now, when we are forming the portfolio with negative and plus two stocks, with this stock negative beta and this stock with the positive beta, so they offset each other. So this is why we see what is the contribution of this in the systematic risk, and what is the contribution of this in the systematic risk. If both minus and plus together, maybe the beta will be lower. Yeah. And the beta again is the beta of portfolio is measured by the contribution of each systematic risk. Okay? I know. Okay, so beta, it could be positive, could be negative. Again, go back to the definition of beta. Is the sensitivity, or to what extent the stock return influenced by the change on the market return? Okay? The unsystematic risk is the element of risk that does not contribute to the risk of the markets. This is not contribute in because this portfolio is not affected by the individual stock risk, because the idea of portfolio is to eliminate the impact of unsystematic risk by diversification. This component is diversified away when the investment is combined with other investments. For example, product recall. For instance, if we have in the car we have the battery is not working, so the companies recall their cars to the company, and because of this, the stock price will decrease. But even if we have portfolio, we can't eliminate against this problem. Labor strike. If we invest our money in IBM, for instance, or in Volkswagen, and only in Volkswagen, so we will have a problem. But if we invest in the portfolio, and the Volkswagen is included in our portfolio, our portfolio will not be affected by this strike. Yeah. So this is the difference between if we invest in one single stock or we invest with the portfolio. Volkswagen is in here, and Volkswagen is just, we have two investors. Investor A invests in the portfolio, and this portfolio includes Volkswagen. And investor B only invests his money in Volkswagen. So now there is a strike or labor strike in the Volkswagen. This will not be affected because it will be offset by the existence or the presence of other companies. But this investors will be affected because it is the only company that he or she invests his money. Okay? So we can eliminate the impact of a strike in the portfolio, but we cannot eliminate the impact of the individual stock. This is the idea of the unsystematic risk. And it works only if we have portfolios.
Non-systematic?
Yeah, systematic and unsystematic. It works only. You compare between this portfolio and this is individual stock. For instance, you have $1,000. This $1,000 invests all of them in the Volkswagen. And there is a strike, so you may lose your money because of this strike. Then another investor has $1,000, so he divided the $1,000, 300 in Volkswagen, 200 in the IBM, 500 in the BMW, for instance. So he may not affected by the strike. Okay. Okay, and I explained this by increasing the number of stocks, we decrease the unsystematic risk. And diversification and unsystematic risk, we eliminate the impact of unsystematic risk by diversification. For the diversification and systematic risk, we cannot eliminate the impact of systematic risk on the by diversification, such as inflation, war, interest rates. Okay. Now stop here, systematic risk and beta. Okay. شكرا كتير.